14.7 million ounces didn't just disappear. It got pulled out of the easiest part of the system to source, and the paper market is trying to price silver like that doesn't matter. Because right now, the headline price is doing what it always does in a stress phase. It looks calm just long enough to make you doubt your own eyes. And then the real signal shows up somewhere most people don't watch. Not on the spot, quote, not on the influencer chart with 3 arrows and a moon emoji, in the plumbing, in the spreads, in the cost to borrow metal, in the way inventory moves between categories that most traders still don't understand. And here's the payoff I'm promising you up front. By the end of this, you are going to know the one calendar window that can manufacture a fake crash, even in a bullish market, the one level that changes the math if it breaks, and the checklist that tells you whether the $120 path is becoming a real probability or just a story. And that's where the real pressure starts. This week, silver has been whipping around the mid to high 70s. And if you're only watching that number, you're already behind the trade. Because the market isn't just a price, it's a structure. It's time. It's delivery optionality. It's who can fund a position after the exchange raises margin, and who gets forced to puke risk into a thin book. Just days ago, the exchange raised collateral requirements again for precious metals, including silver, explicitly citing volatility. That matters because margin isn't commentary, it's a lever. When margin goes up, leverage goes down, and positions that were fine at yesterday as volatility suddenly become illegal to hold unless you bring fresh cash. And when fresh cash doesn't show up, the position gets liquidated for you, not because you were wrong, because the system changed the rules mid-game. But that's not the part that matters. The part that matters is what usually happens right after a margin shock in a market that was already structurally tight. First, you get the flush, the violent dump that convinces weak hands the entire move was fake. Then you get the vacuum. Liquidity thins, sellers dry up, and the next bid has to reach higher and higher because the metal is in T sitting where the price benchmark expects it to be. And if that sounds dramatic, good, because it is. A major bank warning this week wasn't, we're out of silver. It was more subtle and more dangerous. The metal may not be globally scarce. It's stuck in the wrong places, which makes the price hypersensitive and the swings extreme. Location is destiny in metals. And the next detail is what flips the whole setup. When you hear Vault Exodus, most people think it means one of 2 cartoon versions. Version 1, total shortage, no metal anywhere, Mad Max with coins. Version 2, nothing burger, just bookkeeping. Both are lazy. Here's the real version. The exchange-approved vault system has categories, and those categories decide how fast metal can be mobilized to calm the futures market when delivery pressure rises. Eligible metal is basically meets specs sitting in the vault, owned by someone. Our registered metal is warranted for delivery. It is the slice that can be delivered against futures without a whole negotiation. Metal can leave the vault entirely, or it can shift between eligible and registered, or it can sit still while ownership changes. And here AS, why the 14? If that pool shrinks, the market doesn't politely reprice over months. It snaps. Because if this one level breaks, the math changes. Now, I'm not going to sell you fake precision. Even if the exact number in your feed is off by a few million ounces, the mechanism doesn't care. Multi-million ounce withdrawals or reclassifications in a short window are big in the context that matters: deliverable availability and confidence. And confidence is everything in a leveraged market. The exchange publishes warehouse stocks, but the warehouse number is in T, a promise that metal will be offered to you at the screen price. It's a disclosure of what's sitting in approved sheds under particular rules. The moment the market suspects that a meaningful chunk is not available for delivery at any reasonable price, the futures curve starts to talk, and that's where the lie detector lives. Spot can be fine while the curve is screaming. When the front month starts trading firm relative to later months, when spreads get tight, when backwardation appears or threatens to appear in a metal that usually carries in contango, that's not a vibe. That's the market pricing immediate scarcity and financing stress. And it forces behavior. Shorts that used to roll comfortably now face a cost. Dealers that used to warehouse risk now have to hedge more aggressively. Anyone funding inventory now has to think about the cost of borrow and the possibility that their metal can be sourced where they need it. And then the paper market stops being a smooth ocean and turns into a tide pool. Every wave moves everything. But there's a hidden detail the mainstream almost always misses, because it doesn't look like a headline. It looks like plumbing jargon. EFP, lease rates. The spread between where the benchmark is set and where the metal actually is. An EFP, an exchange for physical, is one of the ways futures exposure gets swapped into an OTC position tied to physical settlement, often bridging New York futures and London bullion flows. When those mechanisms get stressed, you can feel it in the price of bridging the markets. And lease rates, the cost to borrow physical metal, are like a fever chart. When they spike, it's not because everyone suddenly became emotional. It's because someone urgently needs metal now, in a specific place, and the pool of lendable inventory is smaller than normal. And that's where the real pressure starts. Over the past year, silver has been dealing with exactly that kind of story. The metal migrating, inventories in key hubs tightening, and the market becoming more sensitive to incremental demand because the cushion is thinner. That doesn't mean no silver exists. It means the system is less elastic. In a less elastic system, price moves are not linear. A small change in flow can cause a big change in volatility. That's why a bank can say, in the same breath, not a global shortage and extreme swings. Those are not contradictions. That's market structure. It's like saying there may be enough water in the world, but if the pipes feeding your city are clogged, your tap runs dry. And, crucially, major commodity indexes rebalance around this time. That's not theory, that's mechanical flow. Funds that track benchmarks like the Bloomberg Commodity Index and the S&P GSCI have to adjust weights to match index rules. When gold and silver have had huge prior year runs, their weights can become too big, and the index forces selling to bring them back in line. Silver is especially vulnerable because it's smaller and more volatile. So here is the nasty twist. The market can be structurally bullish while the calendar manufactures a short-term downdraft that looks like the top. And that's where the emotional manipulation happens. Because if you don't understand forced flows, you will misread a mechanical dip as a fundamental collapse. You'll sell the low right into the hands of people who know the schedule. And the next detail is what flips the whole setup. When forced selling hits a market that also has location stress, the curve can do something counterintuitive. Front-end tightness can persist even as the screen price dips. In other words, the price can fall while the physical stress doesn't fully relax. That's when the divergence between the headline and the plumbing becomes a setup. Because if the dip is driven by leveraged longs getting squeezed by margin plus passive index selling, not by sudden abundant supply, then the dip is not the market rejecting silver. Well, darn. It's the market clearing weak hands and resetting positioning. And resets are gasoline for the next move, but only if the key level holds. So let's talk levels in a way that's honest. Silver recently tagged the low 80s in this early January burst, and it also traded down into the low 70s just days earlier. That tells you the regime. Volatility is not a side effect, it's the feature. In this regime, the level that matters is not a single penny. It's a zone. The first zone is that recent high area around the low 80s. If silver can reclaim that area and hold it after this rebalancing window clears, the market is sending you a message. The forced selling got absorbed. The second zone is the mid to low 70s, where the prior flush found bids. If that breaks decisively and stays broken, your bullish timeline changes. Not forever, but for the next couple of weeks. The only responsible way to talk about $120 is as a conditional chain reaction. Not a prophecy, not a guarantee, a map. Here's the map. A $120 print becomes plausible when you get a sequence. 1, a breakout above the recent highs that holds through a retest. 2, evidence that physical stress is not resolving. Spreads remain tight, lease rates stay elevated, EFP-type bridging stays expensive, or inventories in the benchmark setting hub remain low. 3, positioning that's light enough that a new wave of demand creates forced buying, not just voluntary buying. 4, a macro backdrop that doesn't slam the dollar higher and crush liquidity at the same time. And 5, a catalyst that compresses time, some delivery window, policy risk, or supply constraint that makes later unacceptable. If you get that sequence, silver can jump levels instead of climbing them. And that's where $100 becomes a stop on the way, not the destination. But that's not the part that matters. The part that matters is what forces the buying. In a squeeze-style move, buyers are not just bullish investors. They are hedgers and dealers who are forced to buy because their risk limits demand it. Think about it. In a tight front end, shorts who normally roll have to pay up, or they have to find metal. Dealers who sold options have to hedge dynamically as price rises, delta hedging. If the market moves into a zone where gamma exposure makes hedging pro-cyclical, dealers end up buying more as price rises, which pushes price higher, which forces more buying. That's reflexivity. It's not a conspiracy. It's mechanical. And if you're watching the market through the lens of, is everyone bullish, you'll miss it. Because the most violent rallies happen when a lot of participants are still skeptical, still underexposed, still short volatility, and the market's structure forces them to chase. And that's where the real pressure starts. Now layer on the supply chain reality. Silver is not oil. You cannot just turn on a silver well because the price got exciting. A big portion of silver supply comes as a byproduct of other mining, lead, zinc, copper. That means silver supply growth depends on economics and investment decisions in other metals too. Refining and fabrication have lead times. Recycling has limits. And industrial demand is not a meme, it's procurement. Whether it's electronics, solar, or other applications, industrial buyers don't care about your weekly RSI. They care about continuity. When they see risk of disruption, they do two things. They secure supply and they pay up for reliability. That doesn't always show up instantly in the screen price because it can be contracted off exchange, but it shows up in tightness and premiums, in the way metal migrates between vaults. And that's why the stuck in the wrong places story is so important. If metal has been pulled into U.S. vaulting systems due to policy uncertainty, tariff concerns, or just a desire to be closer to the future's delivery mechanism, it can leave another hub, like London, tighter than normal. And London is critical because it's where a lot of benchmark pricing and liquidity is anchored. If London's pool of lendable metal shrinks, lease rates can spike. The cost to borrow rises. And suddenly a spread that used to be boring becomes the headline because the spread is the price of immediacy. But that's not the part that matters. The part that matters is how this plays with investor flows. In huge years, money pours into ETPs and ETFs. That can be supportive, but it also creates a new kind of fragility. Flows become reflexive. When price rises, inflows rise, which tightens supply, which supports price. When price drops hard, outflows can hit, which dumps metal or synthetic exposure back into the market, worsening volatility. This week's bank commentary points out something interesting. Even after big moves, ETF holdings may still be below prior peaks. That means two things can be true at once. One, investment demand isn't maxed out, so there's room for new inflows if the narrative turns. Two, the market is still volatile because the issue is not just demand, it's where inventory sits and how liquid the lending pool is. So you get a market that's not in a manic retail frenzy, but still swings like it is, and that is exactly the kind of market that punishes sloppy positioning and rewards people who understand structure. And the next detail is what flips the whole setup. The market can use this January rebalancing window as camouflage. Here's what that means in practice. You can get a sharp drop and 1,000 takes saying, see, silver topped, while the underlying tightness remains. Then, when the forced selling window ends, the market can rebound violently because the natural buyers, industrials, strategic holders, discretionary macro funds, step in once the artificial pressure clears. And if the rebound breaks back above the key zone near the recent highs, that's not just a bounce. That's absorption. That's the tape telling you real demand just ate a mechanical dump. And that's where the real pressure starts. Now, let's talk about the vault headline directly because I know that's what brought you here. 14. 7 million ounces disappeared is emotionally perfect bait. It triggers scarcity brain. It triggers the urge to buy at any price, and that's dangerous. So here's the clean way to think about it without getting played. First, ask, did metal leave the vault system or did it shift categories? If it left, that is a stronger sign of withdrawal into private custody, industrial use, or movement to another hub. If it shifted from registered to eligible, it may be a sign that owners are pulling delivery-ready status, reducing the pool available for futures delivery without moving bars physically. Both can tighten the effective float. Second, ask, what's happening to the front end of the curve? If spreads tighten or invert, the market is confirming that immediacy is becoming more valuable. Third, ask, what's happening to borrowing costs, like lease rates and to bridging mechanisms between hubs? Elevated borrowing costs suggest the lendable pool is tight. Fourth, ask, what's the exchange doing? Raising margin often happens when volatility is already hot, and it can force short-term liquidation that masks underlying tightness. Fifth, ask, what's the calendar doing? If you are in an index rebalancing window, you should expect strange price action that is not pure fundamentals. If those 5 checks align, then yes, multi-million ounce vault moves matter as part of a proof stack, not as a single magic number. Proof stacking is how you avoid being the exit liquidity, and that's where the real pressure starts. So let's stack the proof fast. 1. The market is in a volatility regime where it can move from low 70s to low 80s in days, so any thesis must respect whipsaw. 2. The exchange has raised margins again, forcing leveraged players to reduce exposure, which can create sharp downdrafts unrelated to long-term fundamentals. 3. Major commodity index rebalancing is happening in a defined January window, forcing passive funds to sell futures exposure in size, especially in precious metals, which can cap price or push it down temporarily. 4. Institutional commentary is explicitly highlighting location stress, metal being in the wrong places, which makes pricing more sensitive and swings more violent. 5. Physical market signals like lease rates have shown a history of spiking when lendable pools tighten, which is consistent with stress in key hubs even if total global metal exists. 6. Supply chain constraints in silver, byproduct dependence, refining lead times, mean the market can't instantly create new supply to meet surging demand, especially if industrial procurement remains firm. 7. Policy and trade factors, including shifting export rules and fragmentation risk, can amplify regional dislocations, making arbitrage more expensive and liquidity more brittle. That is not one argument, that's a system, and systems don't move smoothly, they lurch. But that's not the part that matters. The part that matters is what comes next, in the next week or two, because that's when most people get emotionally wrecked. Here's your near-term roadmap in plain language. You have 2 scenarios. Scenario 1 is the controlled pullback and retest. In this scenario, silver gets pushed around by margin pressure and index selling through this January window. Maybe sweeps below obvious support, scares everyone, then stabilizes. You'll see it in the tape. The sell-offs start to lose follow-through, dips get bought faster, and the market stops making new lows even on bad headlines. The confirmation is not a perfect V-bottom. The confirmation is the reclaim of key zones. First, the mid to high 70s stability, then the ability to challenge the low 80s again. If it breaks above the recent high zone and holds on a retest, that's the signal that forced selling got absorbed and the market is ready to reprice higher. Scenario 2 is the continuation squeeze. In this scenario, the market doesn't give you the polite retest. It grinds higher, then gaps. That happens when physical tightness and location stress collide with underpositioned money and dealer hedging mechanics. You all know you are in this scenario when pullbacks become shallow. And violent rallies occur on seemingly small triggers, like a normal data print, because the structure is doing the work. In that scenario, the risk is gap risk. You don't get to buy the dip because the dip doesn't print. And that's where the real pressure starts. Now, the $120 path. If silver reclaims and holds the low 80s after this forced flow window, the next psychological battle is round numbers. $90, then $100. Markets love round numbers because humans anchor there, and because options and risk limits often cluster around them. If the market clears $90, you will see the narrative machine turn instantly bullish. If it clears $100, you will see the "it in essa bubble ask" crowd get louder at the exact moment the squeeze risk increases, because shorts and underweight funds are forced to chase. And if the market gets into a regime where the curve stays tight, borrowing costs remain elevated, and liquidity thins on rallies, then a move into the 110s and $120 area becomes thinkable as a volatility event, not as a slow climb. But here's the rule. The higher the price, the more violent the shakeouts. A bullish thesis does not protect you from a 10% or 15% drawdown. It often guarantees it, because that's how the market extracts emotional capital from participants. It makes you right and broke, or right and panicked, so you can't hold. And that's the viewer psychology shield you need right now. The market will try to make you trade your feelings instead of your plan. It will dump hard right after you buy. It will rip right after you sell. It will use headlines, margin hikes, index selling, inventory normalizing to trigger your threat response. Your job is not to predict every tick. Your job is to separate signal from noise. Signal is structure. Does the market hold key zones after forced flows end? Does the curve stay tight? Does location stress persist? Does volatility compress before expansion? Noise is drama, intraday flushes engineered by liquidity gaps, social media narratives, one-off comments. And that's where the real pressure starts. So here's how you don't get played. 1, define your invalidation before you enter, not after. If your thesis is tightness leads to higher highs, then a sustained break and failure below the recent support band in the low to mid 70s changes your near-term probability. That doesn't mean silver is dead. It means stand down or resize. 2, size for volatility. If your position size assumes silver will move like a bond, you'll be forced out by normal silver behavior. 3, respect calendar flows. Between January 8th and January 15th, expect weirdness. Don't interpret every downtick as a betrayal of fundamentals. 4. Watch the reaction, not the headline. A bearish headline that fails to push price lower is bullish. A bullish headline that fails to push price higher is bearish. 5. Stop chasing after vertical candles. In a squeeze regime, the hardest thing is patience. But chasing is how you buy the top of a microcycle. And the next detail is what flips the whole setup. The market doesn't need you to be wrong. It only needs you to be emotional. That's how it wins. Now, counterpoints, because credibility matters and silver is a savage teacher. What could stop the $120 path? A sharp, sustained dollar surge that tightens global liquidity. A sudden relaxation of location stress, metal returning to the benchmark hub, easing lease rates, widening spreads, making borrowing cheap again. A macro shock that forces broad deleveraging, where everything gets sold for cash, including metals. A policy move that changes trade flows and temporarily increases supply to the tight region. Or simply demand cooling at the margin. Industrial buyers pausing because they have secured enough inventory for the quarter. Any of these can happen. And if they do, you'll see it first in the plumbing. Spreads loosen, borrowing costs fall, volatility compresses downward and rallies fail. That's your what would weaken it checklist. Because if this one level breaks, the math changes. But if those weakening signals don't show up, and instead you see the opposite, tight curve, repeated inventory stress signals, and the market absorbing forced selling, then you re-looking at a setup where the next move can be fast, unfair, and higher than most people think is reasonable. That's what markets do in late-stage tightening. They punish both sides. They make bulls suffer on the way up and bears suffer at the top. And the winner is the person who respects mechanism more than narrative. So here's the simplest near-term checklist you can carry into the next week. Watch the calendar. The rebalancing window is the storm. Watch the tape during the storm. Does selling keep working or does it start failing? Watch the key zones. Can silver hold above the mid-70s and later reclaim the low 80s? Watch volatility. Are the down days getting smaller? Are the recoveries getting faster? Watch the structural tells. Is the market still paying for immediacy? Are borrowing costs still elevated? Is the story still metal in the wrong places? If those line up, then the Vault Exodus narrative stops being clickbait and starts being one layer in a real thesis. And that's where the real pressure starts. I'll leave you with the most important mindset shift for this tape. Don't confuse a brutal pullback with a broken thesis, and don't confuse a euphoric rip with a safe entry. Silver is going to whip you around even if you're right, because it's a leveraged, structurally sensitive market. Your advantage is not prediction, it's preparation. And if you were the kind of investor who wants the truth in the plumbing instead of comfort in the headlines, you already know why this matters. Because the moment the market can T-source metal cheaply in the right place, the paper price stops being the price and starts being a lagging indicator. Stay obsessed with mechanisms. Stay disciplined with levels. And don't let the calendar bully you out of a plan you built with logic.